Hi everyone, thank you for joining us today. And today the topic that we're going to talk about is the FRR. And I am presenter Leo. Just before we start our webinar, I would like to quickly introduce Waystone as a company. So in terms of Waystone, we are actually a global compliance service provider providing specialist service to client in the asset management service and also the finance industry. We have over 1,700 people in globally, and then also work in different places. And then currently we work in 27 locations worldwide, including Singapore, UK, Hong Kong, US, Cayman, and also Middle East and Europe as well. So for a compliance solution, we have different program. So the first one is we work for the SFC license applications for our clients. We also work as a ongoing compliance consultant with the client. Also, we do SFC mock inspections where we actually pretend to be the SFC case officers and then perform the mock inspections for the client. We also have internal audits, helping the client to draft our compliance manual internal audits and also deliver trainings and CPT for them. So for the webinar today, it should also count as a 1 hour for the CPT hours as well. So I hope everyone enjoyed the webinar today. So just before we start, I'll quickly go over my background so that everyone will have a brief understanding of myself. I am the director of the compliance solutions for Waystone in Hong Kong. A brief introduction is that I initiated my career when I was in PricewaterhouseCoopers, where I performed audits for licensed corporations and funds as well. And then later on, I joined the Financial Service Risk and Regulations team so that we basically focus on the compliance projects and program for different clients. Most of them are actually SFC licensed corporations. After that, I actually joined several compliance consulting company, and then the first one of them is called ACA Compliance Group. And then after that, I'm also quite a few compliance head officer for SFC licensed corporations, which included asset management firm, brokerage firm, and also crypto prime brokerage firm as well. And then this is actually a basic introduction of myself. Right. So for today, we're going to talk about four topics. The first one is introduction to financial resource rules, where we actually go through what is FRR, what is this all about, why the responsible officer should care, and then a brief introduction of this. And then secondly, we'll also talk about the paid up share capital and liquid capital requirement for different SFC licenses. Thirdly, we're going to go through the common FRR topics for managers. And then lastly, we will go through the recent regulatory updates. Right. So what is financial resources rules? A lot of our clients actually ask these questions. So the reason why they ask me is not they don't know what is financial resource rules. The reason why they ask is because they don't understand the basic concept. Why do they have to fill in the financial resources return? So, as a brief introduction, the financial resources rules is actually a requirement under the section 145 of the SFO Cap 571. So we'll just call it Cap 571 or SFO later. And also the SFO Cap 571N, which is specifically talks about the rules related to financial resources rules. So this is actually the requirement mandated in the ordinance. So we have to follow the financial resource rules and also submit the financial return to SFC on a regular basis. So I assume most of the fund managers already know this because you have been filing the semi-annual financial resources rules on a regular basis. So in terms of the financial resource rules. So every SFC licensed corporation have to follow the we call it FRR. So I guess it's not very it's just this concept is not a very complicated concept. It's actually quite understandable. As if you could look at the financial institution in all across the world, banks or different financial institution in the brokerage services or whatever, a lot of them are actually subject to the regulatory capital requirement in different forms. So it's not a very kind of a new concept. Um, the FRR is actually being used by the SFC as a monitoring tools. The monitoring tools are actually, to firstly, the last whether the last corporation is actually following the SFC rules. So SFC will actually monitor it in terms of whether the last persons or maybe, for example, the responsible officers, whether they are actually complying with the rules. And if they're not, then the senior manager or the responsible officers will have a financial problems issues among themselves. So it's not only the problem for the other corporations. The senior manager will also be in trouble if they're not complying with the rules. We can also take a look at the example that I'm going to show later in the uh, near to the end of this webinar. Right. So in terms of the operational monitoring, there are actually many rules talk about how the large corporation should be following the rules. The rules itself are actually complicated because the rules are actually they're actually separate into different places in the ordinance. So it's actually very hard to gather them and then to summarize them in a way that's actually more presentable to the readers. So this is actually one of our job is to help our clients and also help our maybe the participant of the webinar to understand a bit more in terms of FRR. Right. So the purpose of the FRR, I'm sure most of people should know, but I'll just have a brief introduction about that. So the first one is the SFC have to ensure that the largest corporations are financially sound, have adequate resources to provide service to investors, and also have a sufficient capital base which is appropriate for risk of the business. Right. So the first one is financially sound. This is actually very important for SFC because if listed corporations, for example, if they have been receiving clients or investors fund to manage their funds and all that, and then all of a sudden it couldn't operate because of because it had run out of the funding, and then well, the investors will definitely be complaining, and then the SFC does not really like that. So one of the key point or one of the key topics that SFC looks at is BCP, the Business Continuity Plan. So it is one of the key requirement for SFC is to ensure that the corporation can actually operate financially. And then if it's not possible, then SFC should have, ensure the electric corporation should be stopping the regulated activities at least in a very early stage. The second one is have adequate resources to provide service to investors. This is actually similar to the first point. If you think about it, if the Dutch corporation does not have adequate resources that in terms of like the financial resources, then they may not be able to hire the adequate or the competence personnel to perform the service to the investors. This will not only affect the Dutch corporation's image itself, but it will also affect the financial institutions' impressions to the investors it cannot in front of the whole industry. So the whole industry's impression, the image would be affected, not only the last corporation itself. So SFC have to avoid having some of the companies that are not being able to provide services. SFC has to ensure that this should not be a common scenario. And then the last one is having a sufficient capital base, which is appropriate for the rest of the business. This is actually very so SFC actually have a lot of the tools or a lot of the method to look at the sufficient capital basis. So as one of the topic we can talk about later is the paid up share capital requirement and the liquid capital requirement. So the different capital base will be depending on the business and also the different situations. So we will talk about it in more details in a bit. Right. So for financial resources, as we mentioned, it's the paid-up share capital, and then the short form is actually PSC, and then the LC will be the liquid capital. For the regulatory capital requirements, we've just mentioned this point earlier. It's actually being identified in those of the capital market as a core regulations. In Hong Kong, for the banks, they have Basel II and Basel III that about this type of framework to regulate their financial resources. So it's in a way similar to what SFC does with the FRR, but in a different way. So but most importantly, they're all actually focusing on the regulatory capital requirements. Right. So just to demonstrate what is actually what the FRR is actually talking about. So I hope everyone can actually take a look at this, management account of this asset management firm. As you can see, we have for assets we have 360,000 Hong Kong dollars. For which 60,000 is related to the management fee receivable, 100,000 is cash, and then 200,000 is related to the fixed assets and other long-term assets. In terms of the liabilities, we have amounted to parent company. So the parent company actually lend the money to the licensed corporations, and then we also have other payable. So just by looking at first glance, we can see that after asset deducting the liability, we have 310,000. And then we can see that the equity seems like that it's very sufficient to withstand the risk. I mean, if you just look at it in an accounting sense. So I'm sure everyone with I mean not everyone, I mean like a lot of our attendees, if they are new to accounting, then you may know the assets minus liabilities equals equity. And then as we can see equity, we have a lot of equity. And then if we set a threshold to 100,000, I'm sure a lot of people should know what the threshold means here, but I'll just put as an example here. So in this, if we just look at the management account, we can see that the threshold comparing to the equity itself, there's still 210 excess to it. So if we look at the FRR itself, yeah, as we can see, so I'll just go through one by one. So if you look at the FRR, we would actually, how do we actually see FRR? Is that FRR is the book that is being viewed by the regulator itself. So if we look at the management account FRR, we can see that there actually is some adjustment from the management account to the FRR. For the management account, we noted that the other long-term assets has adjusted 100,000, from the original amount, and then it becomes zero for the FRR. And then it is the same for the fixed assets. And then for the management fee receivable, there's actually a partial reduction from the amount. So we can see that after deducting the long-term assets, we can see that they're actually zero after the reductions. And then the 200,000 has become zero. And then for the cash, there's no reductions. And then for the management fee receivable, we have 50% reductions here. For the liabilities, there's no reductions here, as we will also talk about it later in a bit for the liabilities. And then afterwards, we can see that the liquid capital, so it's similar to the equity amount. The liquid capital is deducting 130,000. Deducting 50,000 from the 130,000, and then it becomes 80,000. If you look at the threshold again, the 100,000 threshold, we can see that the 80,000 is not sufficient it's not sufficient, and then we can see that the excess is actually a negative number here. Right. So if we talk about this in the FRR form, before we continue, just quickly mention the LA is the liquid assets, which is comparable to the assets itself after adjusting the amount. And then the RL is the ranking liabilities after adjusting the risk from the liabilities. And then asset minus liability, which is equity, should comparable to the liquid capital, LC. The ROC is the required liquid capital, which is the threshold, and then the ELC is actually the excess amount. Right. So we can say if the amount is above the ELC, it should be yeah, in a way safer than it's not. Okay. So if we look at this, we can see that the company is actually having a negative ELC and the FRR is not very sufficient. Um, a lot of the for a lot of the fund managers or a lot of the MIC of accounting or compliance, we should already know that because the management account, even the management account seems to be very financially healthy, it doesn't mean that it's actually healthy in the eyes of the regulators. This company is a very good example, showing a very good example in this. So because the long-term assets and the fixed assets usually is not able to be converted to liquidity in a very in a situation of like a financial distress. So in the eyes of a regulator, we should always treat it as a zero, just in case we couldn't convert that into cash to ensure the company can operate in a short term. For cash, we can always use this for any form. So there will be no reduction from the cash. And then for management fee receivable, because we can see that this is actually a very, it's not a very common situation, but for this case, we have a management fee receivable for 10K for each month for 6 months. So the first 3 months, we would treat it as a liquid assets, and then we take that as a put that in the liquid asset itself. But the remaining 3 months, we actually treat it as a non-liquid assets, and then we remove it from our FRL. That's why we can see the majority of the assets are being removed from the liquid assets calculations, and this is why we can see that the book is not very healthy in the FRL sense. I mean, I hope we appreciate that if a lot of our attendees do have at least a basic understanding of FRR, but if you don't, at least by reading this table, we hope that you can also get a sense of how the FRR is operating and how it's actually a bit different from the management, the accounting itself. Right. So for the FRR, the general rules for the FRR is the more risk is being undertaken, the more required financial resources is being needed. The risks are actually, we actually look at the risk in different forms. The first one is the business risk. So if we talk about business risk, we can say that, for example, if we perform different regulated activities, it will be different in terms of the risk you're taking. So for example, the RA9 is actually asset management. And then for the RA149, it's maybe, for example, if an asset management firm that also performs dealing in securities and also perform advisory of securities as well. So you can see that an asset management firm can only obtain the Type 9 license, or also the Type 1, 4, and 9 as well. So it really depends on what regulated activities you take, and then what kind of activities that you take. Even though both company could be asset management firm, there could be more activities that's being taken by one of them, and then hence that the company that have more activities could mean that they're taking more risk, and then they require more financial resources. We will go through the requirement in terms of the financial resources in the following pages. For the licensing conditions, we have a licensing condition called SLC, which is being called the specified licensing conditions. The specified licensing condition means that the company is subject to a condition that it cannot hold client assets. So if you're able to hold client assets, it means that there's actually additional risk to your company's operations, and then in the view of SFC, you will need to subject to a higher financial resource requirement. And then if you do not hold client assets, then there will be less risk, and then you'll be subject to less required financial resources as well. So apart from the licensing conditions, we also have so for example, we have a difference in terms of how the tenancy agreements are being used. So, for example, if less corporations have rented a office and then that address is actually being used for regulated activities, then in terms of our FRR adjustment, we can actually remove or reduce the amount of our rental liabilities by the amount that's being used from the lease liabilities. We will go through this when we talk about the tenancy agreement in the third topic, the common FRL topics. So in terms of the next one is a position risk. This part is actually more focusing on the proprietary positions a licensed corporations actually hold or trade. In terms of the proprietary positions, we have a concept called haircut. So the haircut concept means that it's actually that amount that we reduce from the assets. So the asset minus a haircut will be equals to the liquid assets we input in our FRL form. So we will talk about this later as well. But it's as a demonstration. Some of the stocks that we actually purchase as a proprietary position would have a higher haircut than others. This actually reflects on the risk being taken when you enter into certain proprietary positions. So the S&P stocks and Nasdaq stocks are actually a good example. So as we can see, the regulator would treat the S&P stocks will be a safer positions compared to the Nasdaq stocks, because Nasdaq typically have a higher volatility rate, and the market seems to be more volatile. So the price risk will be higher. And then this is the reason why we have a higher haircut in the Nasdaq stocks. We will talk about this in more details in a bit as well. In terms of liquidity, we also have different adjustment. And then one of the example is that time deposits. So a lot of people will say, oh, time deposit is very safe. Why do we have to adjust the amount from the FRR? As we can, because the regulator look at this in a different way. So if, for example, if there's actually a financial distress, and then the licensed corporations have to pay an amount of liabilities in a very short period of time. But if you enter into a time deposits, and then if, for example, if the time deposits actually mature in 1 year, that amount of time deposit is not very useful for covering the liabilities in the short term. So this actually a mismatch of your asset and liabilities, and then the regulator actually see that the time deposit with a long maturity time will have a higher risk, and that's why they actually do not allow the time deposit that have a maturity larger than 6 months to be treated as liquid assets. Of course, and also including the accrued interest related to time deposit as well. Right. So for the I think the haircut positions is also relevant to this. So if you treating, for example, the Hang Seng Index stocks and then compare that to the warrant as well, we can see the warrant the warrant's position we treat as 100% haircut, and then for the Hang Seng Index we treat at 50% haircut. Some people may ask why 100% for warrants. Well, the answer could be simple. If you talk about the warrants, if the warrants actually if the warrants actually in a position that it cannot reach the strike price, then the position in the warrant could be zero. When the time actually when the warrant actually mature. So we can see that the haircut applies to this in terms of liquidity and also in terms of position risk reasoning. Right. So for concentration risk, as we can see, if we have a concentrated exposure to a single proprietary investment, depending on how concentrated we are on that positions, we could also have to adjust the risk in terms of adjusting the ranking liabilities. We'll also mention this in later in the slides. For counterparty risk, as we can see, we also take account into the counterparty in terms of, for example, whether this counterparty is the credit risk is actually higher than the other or not. One of the way that we look at this adjustment is the fee receivable. So SFC allows the licensed corporations to include the receivable amount in the liquid assets with two main points. The first one is if it's actually being accrued and first being due for payment within 3 months, and then also it has to be a regulated activities, then you can actually treat that as a liquid assets. Also, if the amount is actually being billed but fallen due and remain outstanding for 1 month, then after the 1 month, you cannot treat that as a liquid asset. This is because if it's being outstanding for 1 month, there's actually risk that the person is not being able to repay the amount. So there's only 1 month of liquid asset being allowed to be treated in liquid assets. For gearing risk, we can also see that there are actually quite a few requirements that the licensed corporations have to notify SFC if that occurs. So there's a few. One of them is so if the licensed corporation actually draw down on any loan exceeding the aggregate credit limits, then upon that events happens, you have to notify SFC. If it's unable to meet the core demand for the payment for 3 consecutive business days, whether any lenders has actually informed that it will actually liquidate the securities provided by the licensed corporations, or if that amount is actually or exceeds or likely to exceed 5 million, and also whether if any outstanding claims made in writing by lenders. So all of these are actually some risks in terms of whether the company has taken down or unable to meet any loan demand, or whether the lenders actually liquidate securities. These are actually about how the company could not deal with the gearing risk and the loan risk. So SFC need to know that the licensed corporation is not being able to do this, and then it may, subject to different situations. It may impose more licensing conditions or whatever to lower the risk. The other one would be the variable required liquid capital. So we'll talk about the variable required liquid capital in the following slides. But just as a basic concept, if you have a very large amount of liabilities, then there will be a higher variable required liquid capital, and then the amount that's being included in the regular liabilities will be the 5% of the basic amount, which we will talk about this in the later. And then, so if you want to, if there's actually more liabilities, and then that also affect the variable required liquid capital, then there will be less liquid capital available for the licensed corporations to operate, which means since you are taking high risk, then the licensed corporation is not able to take on more activities due to the lower liquid capital is being available for the licensed corporations. And then lastly, the off-balancing risk. So licensed corporations, there's actually a requirement from the SFC that if the licensed corporations intend to enter into any OTC derivatives other than the options written on its own account, interest rate swaps or FX agreement, then it has to notify SFC 10 business days before the entering into the positions. So SFC wants to know that if you're having at the off-balance risk, which, for example, because the licensed corporations entering into this type of positions could subject to a high off-balance risk. So as this type of OTC derivatives could have a very fluctuating, valuation risk and then all that. So if you enter in these positions, then the regulator will have to take a look more carefully in your company, and then they have to make sure that despite in the split of the proprietary positions, you are able to operate and then serve your investors or clients, in a normal course of business, and they would not, and then the business would not be affected by the proprietary positions. So as we can see, um, different risks could affect the different financial resources requirement from the SMC itself. Right. So for now, we were going to quickly talk about the paid up share capital and then the new capital requirement. So the PSC, as we mentioned, is actually a paid up share capital requirement. So it's actually the regulators, SFC, will have to ensure that dozen corporations have the adequate paid up share capital in their management in their account before they could actually allow you to carry on certain regulated activities. So the requirement for the paid up share capital requirement is, firstly, it has to be registered as a paid up share capital with the company secretary. It has to be registered, and then it has to be paid up. So the amount of cash has to be paid up into the company and registered before it being counted as fulfilling the requirement. The one point have to be noted is that if there are actually more than one regulated activities, and then one of the regulated activities have a higher paid up share capital requirement, then the higher requirement would be the requirement that the company has to follow. The other one is the required liquid capital, the ROC. The concept of the ROC is simple. The ROC is actually the higher of the floor required liquid capital and the variable required liquid capital. And then the main rules is the LC has to exceed the ROC at all time. So it's similar to the PSC. The ROC is if you have more than one license, more regulated activities, more than one license, and then the highest required capital of that license would be the one that the license corporation have to follow. Right. So for paid up share capital, we have actually listed out the requirement for different licenses here. So the reason why we want to have this here is that different license corporations have different requirements. And then if, for example, if one of the asset managers, if you have type 9 as a firm, and then you're looking into applying for different licenses, for example, the type 1 or type 4 or whatever, then we can also look at this table and then you may be able to understand what paid up share capital you have to have in order to obtain the licenses. I'll just go through it briefly. We wouldn't take a lot of time to talk about this. For the type 1 license dealing with securities, depending on whether you'll provide a margin or not. So the margin financing is talking about like the brokerage services. For type 1 licenses, it's talking about dealing securities. So for example, if a securities brokerage firm if they want to be a securities brokerage firm and they want to do margin, they will apply for the type 1 license. But for asset management firm, the reason why they obtain type 1 is not because they want to be a securities broker. A lot of the case, the asset managers that apply for type 1 is because they want to distribute funds being managed by other license corporations or to perform marketing for certain companies on all that. These are actually all included in the type 1 licenses as well. So this is one of the main reasons why they apply for type 1. So unless you act as a securities broker, and then you also provide margin, then you need to have you have to have 10 million Hong Kong dollars in your paid up share capital. Otherwise, if it's a normal type 1, then it will be 5 million for your paid up share capital. And then if you only act as a proof introducing agent or solely as a trader, then you will be 0 in your paid up share capital. So the first two is actually less common in the sense that they're actually less approved introducing agent for now. For type 2 is similar, but there's only if you act as a clearing dealer for type 2, then you need the 5 million in your paid share capital. Otherwise, it will just be 0. And yeah. And I wouldn't go for all that. Everyone could actually, look at our table, and then you could also look at the requirement and see whether certain types of license would need the different payoff share capital requirement. In terms of type 4, 5, 6, and type 9 and 10 as well, I will quickly discuss about it. So as we can see on the remarks, there's actually something called subject to SLC. Right. So we actually mentioned the SLC just now in the previous slides. The SLC it means that it's actually a condition that license corporation must not hold client assets. Right. So in terms of this, if the license corporations is subject to SLC, i.e., is not being able to hold client assets, then you will not be subject to the paid-up share capital requirement. But the other way, if you're not subject to SLC, then you need to be fulfilled the paid up share capital requirement, and it will be 5 million as well. So the same case for type 9 and 10. Right. So I'll not go through all of them. And then lastly, type 13, which is a new regulated activities, is actually being official, and then the paid up share requirement for that is 10 million. Right. So that would be the pair share capital requirement. And then the next one is required liquid capital. Let's go back to the previous slides. As we can see, the required liquid capital is actually the higher of the floor requirement and the FRR requirement, right? So first now we talk about the floor required liquid capital first, and then we call it the floor RLC, the FRC in here. Okay, so the floor required liquid capital is actually the basic requirement that all corporations had to follow, and then most of them are actually 500,000 Hong Kong dollars for example for type 1, and then for type 2 and all that. Either if you act as a securities broker, or if you actually, for example, if you distribute a CIS or whatever, that in that case, then you'll be subject to the 3 million requirement for the required liquid capital. And then similar to type 2 and 3 as well. So I will not to go through too much about this. But for 4, 5, 6, 9, and 10, I'll quickly talk about it. It also the specified license condition also affect the requirement of the required liquid capital. So if you can look at the type 4, 5, and 6, if you're not subject to SLC, for which you could actually hold client assets, then your required liquid capital would be 3 million instead of the 100K that you originally have. So it's the same as for type 9 as well. So the other licenses are actually for reference for everyone. Okay. So just to demonstrate our understanding in terms of the required capital and then the payout share capital. For this case here, we have the minimum paid up capital and floor requirement. For the ABC asset management firm that holds type 149 licenses. The type 1 business is actually distributing CIS, and then type 49, they do not. That's not required to hold clients for this business. Okay, so what it's saying is that for type 49, for working on the business, they're not required to hold the client assets. But for type 1, it seems that they may be able, or they may need to hold the client assets. As we go back to the previous slides, we can see that whether it hold client asset does not affect the floor requirement for the type 1 dealing securities. And for payout share capital, as we can see, it does not affect the payout share capital requirement as well. So as long as you do not take margin financing, the payout share capital for type 1 will be 5 million. And then for the required liquid capital, as long as you do not do margin financing, it will be 3 million, or otherwise, if you're the fiduciary agent or trader, you'll be less. But for this case, it's not less. It's actually the part that we talk about is actually case. So it will be 5 million for the minimum share capital, and then it will be 3 million for the required liquid capital for type 1. For type 4, they do not hold client assets. So for type 4, it actually would just be the minimum payout share capital will be 0 because payout share capital. So as we can see, it's 0 for if it's subject to SLC, right? So in this case, actually a bit different because as long as you are type 1, usually you will be subject to SLC. But there are cases that if you are type 1, 4, and 9, and then it actually applies to the condition that it does not hold client assets, then for type 4 and 9, it will be less. So this case, this is actually the scenario we're talking about. But for type 1, it will have a higher share capital requirement and the required capital requirement. So overall, we'll take the type 1 requirement, and then the overall will be 5 million for share capital, and then required capital will be the 3 million. Right. So now we're going to talk about the common FRR topics for fund managers. So the first topic we're going to talk about is the time deposits. So in terms of the time deposits, we cannot include everything into the time deposits. The part that we can actually include in the liquid assets is actually the time deposit that would mature within 6 months, and then of course the related accrued interest as well. For the second topics will be the remittance of or exchange control. So if the assets that are being placed in a country or jurisdiction that has remittance or exchange control, then most of the assets will be treated as not included as liquid assets, unless the amount of assets, for example, a cash amount that's being placed in their jurisdictions, could be the Lance Corporation can actually reasonably believe that it will be able to obtain the approval from the regulators within 1 week. And then to determine whether the Lance Corporation could obtain the required approval within 1 week, for this amount, then the Lance Corporation have to document the reasoning in terms of like how, for example, if they have obtained past approval from the regulators, and then that experience could prove that it could actually be able to obtain the cash or amount transfer out of the country, then in that case, then they can treat it as liquid assets. For the other point, the Lance Corporation is also if the Lance Corporation is able to use the amount to meet its existing obligations, and then the obligations are dominated in the same currency, then they can also treat it as liquid assets. This part is just for example, if the Lance Corporations have cash, let's say, for example, let's say in Singapore, and then if then the Lance Corporations have some liabilities in Singapore, and then the amount of cash could actually be used to treat that obligations in Singapore, for example. And in that case, it can also be used as treating as liquid assets in the sense. So the third topic would be the foreign branch regulatory capital requirement. So in terms of the foreign branch capital requirement, the Lance Corporation with the foreign branch should not include any liquid assets that is actually subject to regulatory capital requirement. So if you take Hong Kong as a reference, then Hong Kong would need to have, for example, 100K, of course, subject to the additional requirement of the 120% rules and other requirements. So since this amount is being required to be placed in Hong Kong, then this amount would have been not very liquid if the Lance Corporation is actually based, for example, in other places. So in that case, if the amount of cash is actually based in, for example, Singapore, and then you want to use that amount to treat as liquid assets, you can only do so if that amount is not being required to subject to the Singapore regulatory capital requirement. So this is actually the requirement in terms of the cash amount if you want to be placed in the foreign branch. So let's talk about the foreign currency. So the foreign currency, I'll quickly define what is foreign currency in terms of financial results rules. So for FRR, a foreign currency is any cash that's other than reporting currency and the currency that's linked to it. So for example, if it's a Hong Kong corporation, then the reporting currency will be Hong Kong dollars, and then for the currency that's linked to it will be US dollars. So in terms of FRR, the only part that you have to consider foreign currency in this sense is actually anything but Hong Kong dollars and US dollars. Right. So the reason why we have to define this is because for the freely floating foreign exchange, we need for the free floating foreign exchange and also the non-free floating exchange, we will also need to input amount in the ranking liabilities, such that it would cater for the foreign exchange risk in terms of in the eyes of the regulators. So in that sense, there's actually different treatment for freely floating FX and non-freely floating FX. If it's actually a freely floating FX, then the it will be easy. It will just be a net positions. For example, the assets that's actually dominated in that currency, minus fixed assets, non-liquid assets, and also the liabilities as well. And then the net amount of this will be taking 5% of the net positions, and that will be included in the net foreign currency exchange. This amount will be included in the regular liabilities. For the non-freely floating FX, there will be a more complicated treatment. Well, we will not elaborate here because it's going to be too long. So if anyone have any questions related to this, you're free to feel free to contact us after the webinar, and then we can also have a discussion on that. For the last for the fifth topic here is the fees and commissions and commission rebates interest charges. So the fees the fee receivable that arise from a regulated activities and which is accrued and will be first due for billing or payment within the next 3 months could be treated as a liquid assets. If the accrued and first be dealing for 3 months or payment within the 3 months cannot be satisfied, for example, if the amount is actually for due and then it has been outstanding, then you can still include the outstanding amount that is within 1 month into liquid assets. For this part here, if we talk, if the receivable amount is not arising from the carrying on the regulated activities that the Lance Corporation is licensed, then this part cannot be included in the liquid assets. So this part, I think the fund managers that also conduct non-regulated activities should also be aware of when you conduct this. The next topic is the prepaid operating expenses. So the prepaid operating expenses that's included, that is actually incurred within the next 3 months can be included in the liquid assets. So this is easy. For the lease liabilities, so because for the lease liabilities, you have to put a amount of that's called right of use assets in your asset side, and then for the lease liabilities, it's actually on the liability side. In this sense, in terms of this, if the lease liabilities of the corporation is huge, then it would affect the it would affect the variable required capital calculations and also the liabilities calculations. So in this sense, SFC allows the exclusion of the liabilities that's being arising from the lease liabilities or tenancy agreement. So in this sense, we can actually exclude from the ranking liabilities calculation up to the amount that is that does not exceed the right of use assets, and you can exclude that amount from the ranking liabilities and also the adjusted liabilities for the calculation of the variable required legal capital that we mentioned earlier. For the amount due to and due from group companies, this part is very simple. So any amount that is due from the group companies, we cannot include the liquid assets, and then the amount that is due to the group companies, we have to include the regular liabilities. So any amount due from group companies does not help your liquid assets. So please be aware that when you're short for liquid assets and liquid capital. Subsidiary is another topic I mentioned, is that if there's amount if you have a subsidiary, then you need to include in your ranking liabilities the net position of the liability, taking away the assets of the subsidiary, and then also take away the amount due from the subsidiary into the ranking liabilities. For proprietary position, I'll just quickly go through the this part here. So we have different haircuts. So for proprietary positions, you have to include the related amount of liquid assets according to this formula. So the liquid assets will be included as the market value of the stock or the fair value of stock times the 1 minus haircut, and then you will get the amount for inputting to liquid assets. So for different instruments have different haircuts amount. So I'm not going to go through all of them, but so if everyone is actually interested to understand a bit more according to the how we treat the different haircuts for the different instruments, feel free to contact us as well. But we have actually put a very brief explanations in here, so you can also refer to the slide as well if it's useful. And then, so we also, so apart from the instruments in here, we also have specified investment and also liquid investment. So we have all different treatment for every instrument as well, just for your references. For concentration positions, this is actually a part that we have to be aware of when we look at this in terms of the FRR treatment. For the concentration positions, if the amount that we actually held for certain positions actually exceeding 25% or less than 51% of its required liquid capital, then we have to put 5% of the regular liabilities into the liquid capital calculations. And then if it's above 50%, there will be more haircuts for that positions. So we have to be aware of this when we're planning to do priority positions, because we will have a concentration positions adjustment in the liquid capital calculations. For the short positions that we have for the proprietary positions, then we actually have two main scenarios for this. The first one is whether the short positions in securities actually specified in Schedule 2. And also, then we can actually use the market value plus the haircut for the securities and include that into the banking liabilities. For the short position that is under other conditions, we have to put the market value plus the market value of securities. So, i.e., the 200% of the investment into the short positions part in the regular liabilities. So we have to be aware of this when we take the proprietary short positions. Okay, and then there are also other specific scenario that would actually have different treatment. So if you want to understand a bit more into the special treatment, you can also contact us and after the meeting or the webinar. The other specific scenarios that include, for example, short stocks plus long futures, short stocks plus short puts, and short stocks plus long call as well. So there are actually quite several scenarios for this. In terms of the submission FRR, we just want to quickly go through this. So there's a different submission requirement for different types of license and forms. So for example, for type 1, you have to submit your FRR form on a monthly basis, but for type 4, 5, 6, 9, and 10, which that's subject to a specified conditions, then this part you can actually only submit the form in a semi-annual basis. Of course, don't forget if you also conduct a derivative proprietary positions, then you may have to submit the form 10 on a quarterly basis, even though you're subject to the specified conditions. So this would be some of the examples. Submit timing is very easy. It's going to be within 21 days after the reporting period end. So for the December month end, you have to report on the 21st of January, on or before 21st of January. And then for June, you have to report on or before the 21st of July. Signed by the approved person. The FRR has to be signed by the RO or any approved person that you apply to the SFC to submit the FRR. Okay, and then so there are actually quite several notification requirements, and we've actually documented this at PPT. So if you're interested to understand a bit more, you can also contact us. But basically, it's about if there's any related to the loan call or any financial guarantees and any insurance being claimed or whatever, that you have to notify SFC within 1 business day. That also include, for example, the 50% rules and then the 120% rules that we did not mention earlier in this slide here. So it's 120% of the required liquid capital, the 50% of liquid capital compared to last submitted FRR, and then also if the amount actually for deficit, but you have a approved standby subordinated loans. Okay, so you can be aware of this. And then lastly, if you want to enter into OTC positions, you have to notify SFC within 10 business days before the position is being entered, and you will have to and then you will have to notify SFC 5 business days before you change the accounting policy that will affect the paid of share capital and the liquid capital calculations. Okay, if you have to notify SFC for anything, then you need to specify the matters, the reasons, and then also how you can readjust the inability of the liquid capital for follow. So if you got any questions for this, feel free to contact us for any discussions as well. We'll be able to assist you on how to report to SFC on these situations. For this case here, for this case here, just to quickly demonstrate, for the April H2, we have a 50% rules kind of a bridge in this case. So and then on the July H2, we also have 120% rules bridge in this case. So you can also refer to this table and take a look as well. And if you fall below the 50% rules and 120% rules, it's not a big deal. All we need to do is we have to report to SFC in terms of the deficit amount, and also when the last corporations trigger the rules, we have to notify SFC within business day. Then that will be fine. So it's not a big deal as well. And lastly, is a table that talks about immaterial ethics differences that we have a error on our submitted versions. So for this case, we can so different compliance officers have a different view, but in my opinion, because the difference is actually related to ethics, so we can actually treat this as an immaterial error, and it's not required to be to notify SFC in the sense. And as for practical issues, we need to ensure that we have appropriate monitoring mechanisms, ensure that the monitoring is actually down to daily instead of the monthly monitoring mechanisms, try to understand the requirement of the FRR rules so that we will not misinterpret the requirements and inflated our liquid assets, or underestimate the regular liabilities. Ensure that we have adequate audit trail and controls. Ensure that we do enough DD on the system that we use to produce the FRR data, so that if there's any issues on the system, then SFC will check whether you have adequate DD on the provider. New products approval process. So some certain services that the LC provide could actually have any problems with the liquid capital, and then in that case, we need the approval from the senior manager to ensure that this impact are actually being taken account into. So this has to be, so we have to be careful when we have new service launched, and then also for the responsibilities, it has to be bared by the MIC of the accounting or compliance, or the responsible officers that oversee this part here. So there's no excuse for this. So if you have any problems or any issues related to FRR, feel free to contact us after the webinar. And then lastly, just want to quickly show everyone, we have an enforcement case that's related to the Type 9 license. And as we can see, this firm actually failed to maintain its required legal capital for the 100K for 19 months, and then it did not notify SFC within 1 business day, i.e. they notified SFC 18 months after this. So, and then they also failed to submit several FRR returns and its audited financial statements and other documents. So for this part here, it's actually quite, the senior manager is not doing his job well, and then there's actually big issues for this. The RO is actually suspended for 5 years in this case. Okay. Just to quickly go through the recent regulatory dates, there's actually a circular being issued by the SFC on the 2nd of May, 2025, and then the FRR form are actually being updated. So the part that's being updated is actually Form 12, and then the part is being added in the Part C is actually related to hedge fund managers. So so SFC actually inquired 3 questions, the 3 additional questions on Form 12. So the first one is whether the hedge fund if there's for the hedge fund managers, whether the location of group headquarters are actually in Hong Kong or in somewhere else. The second question is whether the NAV or the predominant investment strategies for the top three hedge funds and managed account with the same strategy. So the SFC wants to know the NAV of certain hedge strategies being managed, and then what is the NAV of them, and then what is the top three of them. And then lastly, the number of qualifying hedge funds that has to be reported in the NXA. So the NSA is actually also a new and separate form being requested by the SFC to be filled in by the hedge fund managers. If there is one or more qualified hedge funds. Okay. So the definition is actually being included here for everyone to know. So for a qualified hedge funds, so firstly, the licensed corporation has to be responsible for the overall operations. Or whether the total NAV of all strategy assets globally is at least 500 million US dollar. When they talk about the total NAV of all strategy assets globally, that actually include a lot of things. For example, it include the fund NAV of that strategy, the discretionary account NAV of that strategy, and then it could also be managed by the related companies, not necessarily be managed by the Hong Kong licensed corporation as well. So if the group company actually manage, for example, 300 million, and then Hong Kong manage 200 million, but Hong Kong act as a group headquarter, then the 300 and 200 million will be added up together to calculate this. If it's actually a single strategy as well. And then if the also for the fund NAV, there's actually several things that the fund the NAV doesn't count. So for the NAV, it will include for example, if it's actually a master fund, then the master fund will master feeder fund then the total NAV will only include the master fund NAV instead of the feeder fund. And then if it's actually but the NAV of a multi-manager hedge funds would not be included though, unless it's actually a sub-delegations from the group companies. So apart from the master fund, so for the discretionary account, it will be calculated within this total NAV of all strategy assets globally. But for NXA, for question 9, it will not be included in the calculation for that. It will only be included for the purpose of calculating the qualifying hedge funds. Okay. And then for FRR Form 12, Part B, because in FRR Form 12 Part B, it actually asks about hedge funds and also separate the questions, and they ask about the virtual assets and virtual asset derivatives. So if the virtual assets and virtual asset derivatives are not included, they're actually included in the hedge fund strategy, then it will be separated, and then the calculation of NAV of the 500 million would the hedge strategy should be included. So even though it's being separated in Part B, when you calculate the NAV, it will have to be included to calculate in the NAV for the purpose of qualifying hedge funds. Okay, but for same as above, for the question 9 of the asset class exposure as an SA, the VA should also be included. Okay. In terms of the date, so because the circular is being issued on the 2nd of May, and then the effective date would be on any period after 23rd of June, which is going to be the first of which is going to be June FRR. So the 30th, so the June FRR would be the first month that the revised FRR form would be effective, and then so for this case, because as you will understand, there are actually 3 questions from this being asked by the revised part. So it's C1, 2, and 3 in here. So if we talk about the C3, the part, the number of qualified hedge funds, C1 and C2 is asking about the details and the data in terms of the same reporting period. So it's talking about the June FRR. But for C3, it's asking about the data 6 months before this period. So for C3, we're asking about the number of calling hash funds for the December FRR in the previous year. So the first qualifying hash details being required will be the 31st of December 2024. Okay. And then the timing of info related to Part C of Form 12 would only be required to be filled in June FRR and the December FRR. So even if the fund manager have type 1, have type 1 license, for which they'll have to submit their Form 12 on a quarterly basis, it will only have to include the information for Part C in June and December FRR. Okay. The revised form, we also, and the NSA will have been included in here as a link for the attendees to refer to. And then how we assess the regulatory update, so we open the NXA, there will be a cover page, and then they'll be asking, for example, how many qualifying hash funds you have, and then whether the following is actually registered with obviously regulators and several questions. And then the main part is when they ask about the number of qualifying hash funds, you have to press, for example, one qualifying hash funds or two. Then after that, they'll ask you whether you have to create, you've completed a separate qualifying hash funds for each qualifying hash funds reporting field. And if you click yes, the tab will appear, and then you have to fill the information for each qualifying hash funds in separate tabs. So for each font, you have to fill it in. For example, Q2 and 5 will be asking, Q2 to Q5 will be asking font basic informations. Q6 to Q8 will be asking about the NAV info and the breakdown. And then for Q9, then they will actually be asking the long and short exposure in different categories. So when we talk about firstly, when we talk about the short positions, then we will only refer that into the positive number. So we will input the positive amount of the short positions. So for example, if the short position is 100K, then we'll put just 100K instead of negative 100K. For the master fee structure, we'll only include the exposure in the master level, not the feeder level. And then for the SMA, we do not include the NAV in the SMA amount. Even though we include this amount into the calculation of the qualifying hash funds, we do not include that into Q9 in this qualifying hash funds. Okay. As for side pockets, we can include the exposures in the side pockets held by hedge funds. We need to include them, so we cannot exclude them when we calculate the exposures. And then for cash and securities, then we always use market value. And then if market value is not applicable, then we use the fair value according to HKFRS 13 or whatever accounting principle that you're using for the funds. And then for derivatives, we usually have to input the notional value of the amount or the delta adjust notional value, unless the delta adjust is not possible. For virtual assets, for the VA derivatives, we input in the 9B, and then for VA spots, we include that in 9E. And then the tokenized listed equity, we put it in 9A. So we treat it as an unlisted equity. Okay. And then for reverse repo, because the reverse repo means we're holding the securities, hence we only put that in a long exposures only. For securities position held through derivatives, it should be computed in 9B, not in 9A. And then for corporate bond and convertible bonds, so the corporate bonds will be included in C584 to C591, and then for convertible bonds, it will be included in C596 to C591. When we talk about the investment grade of the corporate bonds, the investment grade would actually be typically actually quite a typical categories. So for the S&P, we'll use BBB minus or higher. And then for Moody, we will get Baa3 or higher. And then for Fitch, we will have BBB minus or higher as well. So for non-investment grade would be the grading below the investment grade, and any unrated bonds will be included in non-investment grade. So this are actually information for the fund managers to apply when they for in question 9. So for question 10 and 11, for the Ripple, for the Ripple, we'll need to we should not be netting of the cash borrowed among collaterals. So there'll be no netting of the cash and securities and the collaterals. And then for securities borrowing, there will be no netting of securities borrowed and collateral as well. So SFC want to know the whole exposure instead of the net amount. So yeah. And then for the for question 12, it asks about the counterparty risk borne by the fund. So as you have a counterparty risk, then for example, if you you can only net the position if there's a legally enforceable netting agreement, and then the calculation is position 1. For example, position 1 is a gain, and then position 2 is a loss. Then you can net the gain and the loss, and then because for the counterparty risk of the fund, it's actually the amount of gain. For example, if you are making a profit of 100K, then the risk for the fund will be the 100K, because the 100K is actually still pending from the counterparty. So if the counterparty default, then the 100K would be the risk taken by the fund. So that's why the net gain minus the net loss would be the risk, but also reducing the amount from the collateral received. So if you receive any collateral from the counterparty, that can also be used to mitigate the counterparty risk. So the net position minus collateral risk, collateral received will be the risk that's being borne by the fund in terms of counterparty risk. And then for the counterparty risk borne by the counterparty, it will be any loss that's being faced by the fund. So the negative amount will be the risk borne by the counterparty. So the net position will be the basically the loss minus the gain amount. But for the net position for the counterparty risk, both of them have to be netting is only possible if there's a legally enforceable netting agreement. Otherwise, you cannot net the amount, and you can only take the overall amount that's being borne by the fund or by the counterparties. Okay. So for the question 19 for the portfolio liquidity, so this actually there's some of the points I want to quickly mention. You can only let the long amount each time for the category should be reported. Only net long. And then for the side pockets, you should always put that is in above 365 days, unless the licensed corporations can prove that it can actually liquidate the side pockets less than 365 days. Each investment should be assigned to only one period. Okay, and then for question 22 for investor liquidity, only net long in each time categories should be reported as well. So the net short would not be required on the net long. So same case for side pockets. Also, you only put it in above 365 days unless the largest corporation can provide otherwise. And then usually for normal market scenario, we'll have to take account to the profile of investors. So for example, with the historical redemption pattern, where the investors frequently redeem or different cases. And then you also have to take account into any redemption notice already received and remain outstanding. Okay. For the asset valuation, for level 3 investment, any level 3 investment should be taken account into the valuation in a fair value amount. And if it's not possible, you can also take the sale price that is above 1 month. So if the valuation is being is being valued in more than 1 month, then you can still use that amount if the level 3 investment is not be able to obtain the fair value amount. And lastly, for question 25, if there's any supplemental information that is you wanted to explain to the SFC, then you can also put that in the Q25. Okay. So this comes to the end of our webinar. If you have got any questions, feel free to email our to the wcshk@waystone.com. And then if there's any questions about the content of the webinar, feel free to let us know. And then we can also schedule a separate course to talk about it. And yeah, so thank you very much for everyone attending. Hope that this session helps everyone. Thanks a lot.